York morning trade on this Thursday. We are looking at the major U.S. stock averages up by about 0.5%. Now, keep in mind that while we did see record highs for the Dow and S&P 500 in the first full trading week of the year, we did see the equity averages pulling back from record highs this week. And investors did rotate out of high-flying tech stocks and into sectors positioned to benefit from a potential growth rebound. And commodities were in the spotlight as gold and silver hit fresh highs on geopolitical concerns, while oil prices this morning are pulling back after seeing gains. Well, joining me this morning is Brian Jacobsen, Chief Economic Strategist at Annex Wealth Management. Brian, thank you so much for joining me. As you and I were talking before we went live on air, it's hard to believe we're only 15 days into the new year. But first, what is driving the rotation that we're seeing in markets right now, and what are you focused on as we head into 2026?
Yeah, thank you for having me. It does feel like we've already sort of lived through almost a full year in just these 15 days. And the starting of the year where you see small caps and value kind of outperforming the previous year's winners, when you get that rotation, that's not unusual. Sometimes people refer to that as like the January effect. It comes from perhaps tax loss selling in the previous year, and then people repositioning and rebalancing. So it's not too surprising to see that rotation initially. Now, the thing I'm watching is there any follow through on that? And I believe there could be, where we see high hopes for a lot of tech companies, and we saw TSMC. Their report really kind of rekindled the tech trade once again. But I'm a little nervous about too high of expectations for tech to keep delivering these double-digit growth rates that we're seeing. Perhaps instead of 35% growth for earnings per share, it might fall short to something like 30%, which was still great. But if it doesn't meet lofty expectations, you could continue to see this rotation with a little bit more momentum building as the winter goes on.
Yeah, and Brian, I'm glad you brought that up because we are looking at the NASDAQ Composite Index higher in today's session. And as you mentioned, we did look at those figures out from TSMC, in particular the outlook and CapEx spending. But when we're looking at the U.S., businesses across the U.S. are starting to pass tariff costs on to consumers. And this is according to the Fed's latest Beige Book, which came out yesterday. Now, according to that Beige Book, only 2 of the Fed's 12 districts noted slight price growth, while the majority reported higher costs for goods and services. So on the heels of the latest economic data points, CPI, the delayed figures, jobs report, what does this mean for the U.S. economy and in turn the Fed?
There was a lot of great information in there to give a little bit of a qualitative description to the quantitative numbers that we've been seeing for CPI and retail sales. So when it comes to the consumer price index and the outlook for inflation, businesses, they did stock up on inventory pre-tariff, and now they are kind of working their way through it, trying to find out, can they actually pass on those price increases to consumers? Some will be successful, some will not be. I suspect that fewer of them will be successful than what we will see in the past, just because of heightened sensitivity of consumers to high prices. So I don't think we're going to see a reacceleration of inflation. This could instead show up as just crimped profit margins for businesses. And then on the retail sales side of things, it was pretty clear in the Beige Book about how higher income individuals are still the ones who are doing most of the spending. Low to moderate income individuals are prioritizing essentials. And I think that good retail sales report that we got for the month of November, decent holiday shopping numbers, a lot of it was either driven by high income individuals or bargain hunters.
And I do want to get your take on one asset class that has been shining in 2026, and that is precious metals. So in today's session, we are looking at a pullback in gold and silver prices, but we have to keep in mind that we have seen quite the run up in the precious metals sector. So although we don't have time to cover all the geopolitical risks, give us an understanding of what we're seeing play out when it comes to commodities.
Yeah, I think that it's the geopolitical risks and momentum trading that we're seeing driving metals prices higher. We saw central banks purchasing a lot of gold from 2022 through 2024 and bleeding into 2025. Retail traders saw that, began piling in, pushing the price higher. And now, whenever you get these geopolitical flare ups, it's more about gold than, say, Bitcoin. And actually, gold is acting like physical Bitcoin in these types of situations. When they cut off internet service, what good does it do you to have Bitcoin in a digital wallet that you can't necessarily access to conduct transactions? And I think that's part of what has been driving gold prices, is just some of these fears, especially in these hot pockets around the world.
And Brian, finally, it is earnings season, and this week we've been hearing from the big bank CEOs on the earnings calls and also getting the U.S. economic outlook for the major banks for the year ahead. So when it comes to your outlook for both the markets as well as individual sectors, what is your outlook for the rest of 2026?
Yeah, I know that it's cliched to say about being cautiously optimistic. It almost sounds like a cop out, but I think it does make a lot of sense just given where valuations are and some of the uncertainty as we're going through earnings season and seeing the price reaction of bank stocks to what are otherwise good earnings, right? So maybe the bar was set a little bit too high for them. I think that the fundamental outlook for the US economy is very good, but a lot of that goodness might already be priced in. So I think cautiously optimistic is a lot better than being either recklessly optimistic or recklessly pessimistic.
Well, Brian, always great talking to you. Thank you so much for joining me as we kick off the new year. I appreciate your time and all of your insights.
Thank you.